Welcome to the On the Horizon podcast, buying and selling businesses, brought to you by Horizon Business Brokers, your trusted guide to buying, selling, and valuing businesses. Your next opportunity is just on the horizon.
Well, hello, everyone, and welcome back to On the Horizon. So, you've went through the due diligence. You've found the right business to buy. Now you just need to pay for it. Got to finance the business. Otherwise, you can't have it. So on this episode, we're going to talk a little bit about financing the purchase of a business. We're going to talk about SBA loans, seller financing, and more. So Jeremy Wolf here alongside Dustin Zaire. In my opinion, the man that you want on your side when buying and selling businesses. Dustin, always a pleasure, my brother. Always a pleasure.
Great to see you, Jeremy, and thanks everybody for tuning in today.
Yes. Okay, so let's get into this. Number one, SBA loan basics. For those out there, let's just start from a blank slate here. What is an SBA loan for those that don't know? And let's talk about how we can utilize that program to finance the purchase of our business.
Sure. So, excuse me. A little under the weather. I apologize. There it goes.
We won't hold it against you, brother.
All right. So SBA loans are probably the most common financing vehicle to be able to purchase a small business. An SBA loan is not provided by the SBA, which is a government agency, right?
Okay.
The SBA is actually providing a guarantee to the lender that is providing the loan.
So I didn't know that. Yep. The more you know, learn something new every day.
The more you know, the more you grow. So you're gonna reach out to the lender. If they're a preferred lender, they have preferred status with the SBA, so it's usually a little bit quicker. Sometimes they can underwrite their own deal without going to the SBA for final underwriting approval. The typical process for an SBA loan is generally 60 to 90 days. I've seen it a little shorter, and I've certainly seen it take longer. So be prepared. It really takes a lot of time to get all the documentation together for the buyer and for the seller. So when you're working with a broker and they have a business, it's a good business. They have solid financials. A good broker is likely going to have that business pre-qualified by an SBA lender, where they've provided the P&Ls and the balance sheets and the tax returns for that business that the lenders looked at and pre-qualified it based off of its purchase price and the cash flow that it generates, that they validated with those P&Ls and balance sheets and tax returns, and will provide a pre-qual letter to the broker. And that will really kind of help support and validate the asking price for the business, and will provide a level of assurance for the buyer that this is probably a pretty good business that I'm looking into to purchase. The buyer themselves will also be required to get themselves qualified. They're going to be sharing their resume, their financial statement, their tax returns personally. And if they own a business themselves, they're also going to have to share their tax returns for the business and profit and loss statements for the business, because any lender is going to want to see what the total overall financial health of that borrower is. Do they have outside income that's going to continue to contribute to their debt service coverage ratio on a global perspective, and not just reliant on the cash flow that the business generates to be able to support the loan? Now, in a lot of cases, a buyer is probably leaving their professional job to operate this business. So the bank is really going to be looking at, okay, well, what are the financial responsibilities of the buyer outside of this loan. Like, they're going to look at everything on a holistic level. What is their car payments? What's their mortgage payments? Because they want to make sure that if the buyer leaves their job and they might be making $100,000 a year or whatever the case may be, they're going to be buying this business. Maybe the business makes, $200,000 a year, but then you have debt service that you need to pay for. And then you have to be able to cover your personal living expenses. And again, you want to have some money left over, for working capital and or to reinvest back into the business. So you need to be prepared as a buyer, what you're going to need to bring to the table and how long it's going to take, because, getting a business loan is not as quick as getting a real estate loan to purchase, a primary residence. And there's other funding options that could be quicker, like HELOCs, like working with private lenders, maybe getting a conventional loan. And we can talk about those things as well, along with maybe having some seller financing. Maybe that's the one of the quickest ways to complete a business purchase. But you probably need to have a significant down payment to do that for the seller to be comfortable to provide financing and have professional experience as well, so they know to be able to successfully run their business and pay their loan back, right?
Absolutely. There's definitely lots of options out there, and I want to get into some of the other options, but I want to take it back to the SBA. So if I'm understanding correctly, you can go to a bank for a loan, and then they might be secured by the SBA, but if I understand correctly, you can go to the SBA, the website there, and basically submit an application directly to them, and they will give you kind of like a directory of lenders to choose from that are linked up, that you could link up with. Is that accurate?
That is a thing. You can definitely try to go through the SBA, website, get connected with one of the preferred SBA lenders.
Is there an advantage one way or the other? I mean, does it matter if you do it through the SBA or you find a lender and they end up being secured by the SBA? Or what's the preferred method of accessing the SBA funding?
Yeah, I found that most of the buyers that we work with, they either already have a relationship with a reputable lender. So a lot of your national lenders, whether it's Truist, Wells Fargo, those are the two main JP Morgan, right? These large banks, they have SBA, loan divisions, right? So then you have your regional local banks. They could be preferred lenders. They may not be preferred lenders, but if they're not, they can still, kind of get access into the SBA 7A loan program. The SBA 7A loan program is specific for business acquisitions. There's also an SBA 504 loan program, and that's for purchasing commercial real estate and or, hard assets for a business. So either way works. We've found that, most of the buyers that we interact with typically work with the lenders that we have had the deal pre-qualified with. And we usually get it pre-qualified with, 3 to 5 lenders to give the buyers options. But if they work with our lenders and, our deal partners, we know that they've already pre-qualified the deal and they're likely to provide financing as long as that buyer meets the professional and financial qualifications.
Got it. So when somebody, I think think people are generally familiar, if you buy a house, right, you put your down payment down and the bank gives you a loan typically, and then the bank takes the house as collateral. Is that analogous in the business sphere where you put a down payment? Are they collateralizing the loan through the business, or is it a personal guarantee? I'd imagine it varies depending on circumstances. Obviously, everybody has different credit history and different assets and different structures, so each deal is different. But what is typically standard in that situation?
So it is very circumstantial, right? Especially considering a lot of small businesses that are acquired are largely valued based off of its goodwill. So the lenders are really providing a loan that is more goodwill based because it's cash flow driven.
Okay.
When I say goodwill, it's the intangibles that the business has, right? So the value generally is derived from the cash flow that the business generates, right? And let's say the average business generates, say, whatever, we'll keep it around $100,000 of cash flow. And it might sell for an average multiple of about 2.5 times. So you have a price tag of about $250K, most of which is probably goodwill, because in a business of that type and size, there's not going to be a lot of, hard tangible assets unless you are, maybe in manufacturing, distribution, for example, those laundromats, which is also why they sell for higher multiples. So it's variable in the sense that the goodwill is exceeding the tangible asset value of the business, right? So your asset value might be whatever, $50,000 or $100,000 or zero, and you're financing a majority of goodwill. So when a majority of goodwill is being financed, then the borrower, or the banker is going to be looking for the borrower to pledge more of their personal assets for security, because there's not enough business assets to kind of secure that loan. There's also some variables, and not to go down a rabbit hole here, but if you are a buyer, borrower, and you have a extreme net worth, if you have a lot of liquidity or equity in real estate or other businesses, you may be disqualified from actually getting an SBA loan, because the SBA loans are really there to provide, insurance, if you will, and assurance for the buyer borrowers that don't have the kind of financial ability and or liquidity or equity to tap into to be able to purchase a business through your conventional needs, right? So in short, again, variable, be prepared to pledge assets of the business that you're acquiring to secure the loan, and or also be prepared to pledge your personal assets as collateral. If you own a property or properties that have greater than 20% equity, you are going to be required to pledge that as collateral for an SBA loan.
Putting a lot on the line out there to take the entrepreneurial leap of faith. Yeah. Lots of moving parts, lots of risks. People don't understand that. I think that the people that do work for somebody else and have that typical job, right? They go in and they do their job and they leave and they have their one job to do. When you embark on starting a business or buying a business, all of a sudden now you're wearing many different hats and you're putting up a lot of risk, and people don't quite understand that. I don't think, that haven't been through that. You're taking a big gamble when you go out and you start a business or buy a business. You really are.
You are. I mean, and it is really, for all intents and purposes, generally an unsecured loan or line of credit if you're financing a lot of goodwill. So interest rates for an SBA loan, right now it's typically prime plus a spread of about 2.5 to 3 points. So it's typically where a lot of lenders are going to price their SBA loan. So if prime's at 7.5, be prepared to have an interest rate of about 10 to 10.5%.
Woof.
Common loan term is going to be 7 to 10 years. But, while that seems high in comparison to what interest rates, were several years ago, prior to COVID and outside of, during COVID and right outside of COVID, when the government was trying to kind of prop up the economy and keep people investing in the economy and small business. And it's gradually gone up as the Fed increased rates. But if you look at the historical kind of runway of where, interest rates are, we're kind of in line, or I'm sorry, how interest rates have evolved. We're kind of in line, especially if you kind of compare it to an unsecured line of credit with a credit card, where, those interest rates can be in the high teens to low 20s. So if you really kind of compare apples to apples, and an unsecured line of credit with a credit card compared to an unsecured line of credit, for an SBA loan that may or may not have, some collateral to secure the loan, I'd rather pay, 10.5% for an SBA loan than be paying, high teens or 20s. So it's still a pretty fair interest rate in comparison.
So Dustin, why is seller financing so common in small business acquisitions?
So it's common in business acquisitions because it's a very personal, type of investment. Small businesses are very personal. They're built on relationships of the owner, maybe sometimes the employees. As we've talked about in previous episodes, maybe there's customer concentration issues. Maybe there's key employees that maintain these relationships. So in order for a buyer to feel secure and confident in the business that they're purchasing, they like to see that sellers have a vested interest in the sale, that they have some skin in the game. If they're providing some seller financing, that's showing the buyer that they really believe in the business that they're selling, and they believe in the buyer that's going to be purchasing that business and their professional experience to successfully operate the business, and to then be able to pay their note, the seller note that they're providing, right? So it really helps build that buyer confidence. Seller financing is also key in some situations that can help the seller offset their tax liability. So, maybe you sell your business for $1 million, and you're going to have capital gains, depending on your overall tax bracket and the deal structure and your entity type. Your capital gains taxes could be anywhere from, say, 15 to 30+%, right? If you have some structure in your transaction with some seller financing, or maybe it's an earnout, the seller's not getting all of their cash at close. So it helps them defer their tax liability to lower their capital gains tax on the onset of the transaction and the sale. And then what they receive, in the years to come is typically treated on an ordinary income basis. So again, depending on what their income is, which is probably less than what their income was if they've been operating a business and making a good wage. Now they've sold their business, so they probably only have maybe a retirement income or whatever income they're getting from their seller note. So that's likely going to have a lower tax liability because they're going to be in a lower tax bracket. So it helps build buyer confidence. Lenders also like to see seller financing for some of the same reasons: customer concentration and those key relationships that they may have with their clients or personnel. So it can play a huge role in completing a successful transaction.
That's interesting. I never really thought about that in terms of the tax liability. Like most people want to get the large cash infusion, but if you could structure it in such a way that minimizes tax exposure, what's good for the goose is good for the gander, right? Can be. So what about alternative financing? There's other options available, things like HELOCs, right? ROBs, rollover for business startups, private lenders. Talk a little bit about those different vehicles.
Yep. So the quickest and easiest is a HELOC, a home equity line of credit. That typically takes 30 to 45 days. So probably one of the faster ways to secure funding to complete an acquisition. Obviously, you're not able to pull out 100% of your equity. So, for example, let's just say I have a property that's worth $1 million, and maybe I owe $500,000 on this property. So at face value, I have $500,000 of equity. Okay. You actually have approximately $300,000 of loanable equity, though, because most lenders are only going to provide an 80% loan to value. It might only be 75% loan to value. So, but that's a very quick and easy way to get access to some capital if you have equity in your properties. Okay. Less scrutiny, obviously, than getting a business loan, because it's really solely based off of the income that you're generating in your current, employment, and has nothing to do with the business that you're looking to acquire. Right. Then you have the ROBS program. The ROBS program allows you to roll over your 401k or your IRA to purchase a small business. So when you're invested in a 401k or an IRA, you're basically buying, stock into corporations that are listed in the open public market, and they are generally C corporations, right, that have issued stock for the open public to purchase. So the ROBS program allows you to convert your 401k or IRA into a C corporation that you form. So you're taking your money out of the stock market and you're putting it into your own stock of your own corporation. And you're able to do this tax-free, where if you wanted to draw from your 401k or IRA that you've been investing in and you wanted to take a lump sum payment, then you're likely going to get hit with capital gains taxes from taking out that money. But when you do it through the ROBS program, it's tax efficient, where you're not paying taxes on the money that you take out. There are fees that are associated, to implement this transfer and to kind of manage the corporation. There's a couple great companies out there that do this, Guidant Financial and Benetrends. If you would like an introduction to anybody at one of those companies, let me know. We'll be happy to make that introduction for you. And then lastly, you have your private lenders. And private lenders could be, for the lack of better terms, just high interest rate lenders or loan sharks.
Would this be like private equity? Is that what we're talking about?
It could be private equity. It could just be,
What's the distinction then between just a private loan and then the private equity?
Yeah. So I would say private lenders are just people that are out there that are providing maybe subprime loans to maybe buyers that don't meet your typical financial qualifications, or buyers that are looking to purchase a business that may not be financeable through your typical SBA or conventional loan structures, because maybe the business doesn't have good financials to support it, or maybe the buyer, the buyer borrower doesn't have the financials to support it. So you have these, private individuals or private lenders that will provide funding at, really high interest rates. Your private equity private equity folks are really groups. They are businesses in themselves. They're typically large groups, family offices.
And they pull together funding from a bunch of investors, right?
They pull together funding from a whole bunch of investors, that are unrelated to each other for the most part. And they're pulling together millions upon millions of dollars to generally buy a business that is typically cash flowing a minimum of, $1 million. We've seen these private equity folks come downstream a little bit more. Maybe they're, looking at $500,000 in cash flow or EBITDA. But most of your private equity folks are, they're looking to invest, millions upon millions, tens of millions, hundreds of millions of dollars into larger, what I would call upper Main Street or lower middle market businesses. So, those are, at least $5-10 million in revenue for the most part, or more. And again, firing off cash flows that are $500,000 to $1 million, because these private equity folks, they're not coming in to operate the business. They're going to be, strategically hiring, presidents and CEOs to effectively take over the ownership role of that exiting seller.
Yeah. So the private equity, they have Now I lost my train of thought. See this? So they have, it just seems like they would have more of a fiduciary responsibility to their investors than the private, like if loan shark, if you will, out there that's doing private deals by himself. It seems like a lot more structure in the latter.
They certainly do. They have probably more requirements. They want to protect, their investors, more so like than the private lenders really just, they're out there lending money at a premium, and
yeah. Now, does the private equity come into play? You mentioned 5-10 million. It's typically for larger deals, right? Private equity is not necessarily getting involved for the smaller deals, or are there cases where they do? Or does it really matter?
So they do get involved in the smaller deals, but generally only if they have like a platform investment already. So like, let's just say they're already operating like maybe a home healthcare agency, right? And it's, they have their platform, maybe they've already done a couple of acquisitions, so they're more open to buying, a smaller, home healthcare agency to tuck into their platform because they already have the back end office management, right? So it's easy for them to fold that in.
Yeah.
But if they don't have a platform, they're not going to buy, a smaller home healthcare agency that's more, owner dependent, lower cash flow, because there's not enough infrastructure there or cash flow there to be able to pay that, president or CEO that they want to insert into the operation to replace that exiting seller.
Yeah, that makes sense. We talked about the down payment before, typically industry standard, if you will, 10%. How important is it to have a strong down payment when buying a business? Like, is it better to put more down in some cases than less? Like, so a lot of people obviously are looking to maximize cash on hand and they don't want to dump a bunch in, but is it better to do that sometimes?
Well, circumstantial, obviously, it depends on, how much cash you have, how much working capital you might be able to get, through your acquisition loan, because you have your acquisition loan, and then a lot of lenders will build in some working capital depending on the needs of the business. Okay. So, some people don't like debt, right? Some people are comfortable with debt, and, as long as they see that the business is going to be able to manage its debt service, then they're happy to just put up the minimum and make their monthly payments. Some people that maybe are a little bit more conservative, and if they have a little bit more cash, putting more cash down is going to lower your monthly debt service payments, right? So circumstantial, obviously. When you're talking about, bank or seller financing, really the more cash available you have for your down payment and or post-closing liquidity is going to put you in a better light, for that lender or for that seller. They're going to be more comfortable and confident that, well, look, if the business took a small downturn for economical reasons, or maybe there's some seasonality, like they know that you have, post-closing liquidity, right? If you're putting up that 10% or more, that instills more confidence in that lender or that seller, because you have more at risk. Like you're bringing more to the table. If something should happen, you're going to lose more. So the general thought is, if you're investing more, you're going to be more invested in the business, because you don't want to lose the money that you've just put down to acquire that business. I think this is really has a huge bearing when you're talking about seller financing as well. Like, especially if it's a majority of a seller finance deal, you have to bring as much money to the table as possible. Sellers are taking a risk, on you as the buyer, just as much as you're taking a risk in buying the business, right? But it's really more of a risk, I believe, in most transactions, that the seller is taking on, and providing the financing to the buyer, because the buyer is able to see that past performance and history. So they can see, hey, this business is consistently, generating X revenues and X cash flow. And, I should reasonably be able to pay, the seller note off. But the seller doesn't know that buyer is going to be 100% capable of operating that business to the same level that they have, right? So they really are taking a huge risk. A seller's generally probably not going to provide, 80 to 90% seller financing like a bank would. That's not pretty common.
Yeah,
or
that makes sense. They want more skin in the game, right?
They want more skin in the game
Yeah.
from the buyer. They want an equal level of risk. So, I mean, for our clients, the sellers that are open to providing seller financing, we say, hey, that's great, but let's limit your risk and your downside. You probably don't want to offer, much more than 20 to 50%. And it's typical that most, deals that have some sort of seller financing, at least for us in our 20-year history, it's been pretty limited to about 10%, maybe 20% at most.
So in those particular cases where you're doing, part of the business seller financing, I'd imagine there's scenarios where the other half comes from cash or comes from a combination of the down payment cash along with some kind of outside other financing, like an SBA loan or something like that. You can kind of glue it all together from different sources.
Yeah, you can
structure.
You can stack it. What's your debt stack look like is kind of some industry terminology, right? So your debt stack could be, senior debt with SBA financing, junior debt with maybe some, private equity financing or private lending financing. Maybe it's seller financing, and then your own, equity or, down payment, coming in, from whatever cash you have or, HELOC that you might've gotten or whatever the case may be.
Now, does the financing structure ultimately affect the valuation of the business? I mean, obviously we just talked about, it's a little bit more comfortable from the seller in some cases when they're getting a bigger down payment. But in terms of the overall valuation of the business, does it really matter how the financing is structured ultimately?
No. So the value is generally going to be derived from the cash flow performance and or, from the assets, that the business owns, right? So value is typically of what the business earns or what the business owns, right? If the deal is seller financed, it may allow you to achieve a full asking price, because it's showing the buyer that you have good faith, where some other buyers that may have paid cash, they're discounting the value of their cash that they're giving you up front because there's a higher level of risk that when they buy their business and they give you all cash, that maybe you don't properly transition and train them. Maybe you're not there around to help them with their customer retention. Maybe you're not there to support them, post-close as, they said that they might have. So it really just helps a seller obtain an at or closer to asking price, but it also can help them achieve a total greater value only with the interest that is going to be, obtained, from providing that loan, right? So, obviously banks are in money, or banks are in business from making money off of the interest from the loans that they provide, right? So when a seller is providing a note, it gives the buyer the confidence to maybe provide a higher price. But then, if this seller note is going to be whatever, 1, 3, 5, 10 years, and you're going to be at typically an interest rate that's going to be plus or minus prime, that's 7.5% right now. You're not getting 7.5% in, a bank account or, a certificate of deposit. I mean, your average returns on the open stock market is, 8 to 10%, right? So you're going to gain that interest over that period of time, which is going to provide you more value, at the end of the day.
We like value, don't we? Oh, yes.
We love more money, right?
Oh, yeah. So lastly, what's on the horizon? Pun intended here. What have you seen? Obviously, AI has become an integral part of everything now. Have you seen that bleed into your business yet with how these deals are structured, and are there resources and software programs available to help analyze businesses and all that kind of stuff? Have you seen that enter your space yet, or is that still upcoming?
Oh no, there's definitely been a lot of AI out there to help business brokers and M&A advisors and buyers and sellers alike. All the professionals, bankers, are using AI to help underwrite their deals now. Brokers are using AI to load the P&Ls and balance sheets into valuation software, where it can pull, all the needed information. So it really helps kind of streamline some of the processes for, the brokers. And of course you have all the AI, tools out there like ChatGPT and Gemini, et cetera, to help buyers and sellers in their searches for, is this a fair deal term, or, is this right or wrong? Unfortunately, not all AI is going to be true and accurate. So it's good to do a search, but I'd be leery of some of the information that you might find, and make sure that you're talking to a professional that knows the market and knows the industry and the common deal terms. So whether that's the broker, M&A advisor, or the attorneys that are on your side. But yeah, I mean, AI is becoming huge and is helping all sides of the equation here in a business transaction, for sure.
Very interesting. I just went on chat and I said, chat, based on what you know about me, I want to buy a business. Based upon what you know about me, what type of business should I buy? Kind of alluding back to what we talked about in the previous episode, but trying to figure out what to do just to see what it comes up as. So I'm in marketing. It says media marketing agency. Okay, that makes sense. Community publication. I put out a community publication. That makes sense. Podcast production. All right, I do that too. Event or retreat business. I like that. Service business with strong branding needs. Lots of resources out there, my brother. We're living in a brave new world. I don't know where we're going from here. It could be amazing. Could be quite scary. I'll tell you what, man. Anything else before we wrap this bad boy up and put a bow on it? What other pieces of wisdom and nuggets you want to drop the audience here before we wrap up?
No, I think we touched on a lot of great points today. Nothing else comes to mind. Happy to talk to anybody that has more questions about SBA financing, conventional financing, seller financing. What could be the best route for you and or the seller that you might be working with, or vice versa. Being a seller and just knowing what you should at least be open to help you be more competitive in the open marketplace as buyers are looking for good, strong businesses and really search for deals that have seller financing as part to help, again, limit that downside risk. So,
all right. So if you're out there listening, if we missed anything, if there's anything on your mind, let us know. Drop it down in the comments below. We'll be sure to bring it up on a future episode and discuss it. We always love to hear your feedback. If you found this content useful, please don't forget to like, subscribe. Stuff helps us out a lot. We appreciate you coming along with us for this magical ride, and we wish you the best of luck on your next venture out there. Everyone, take care. Have a wonderful day, and we'll catch you next time on the next episode of On the Horizon. Take care.
Thanks, everybody. See you next time.
That wraps up this episode of On the Horizon podcast, Buying and Selling Businesses, brought to you by Horizon Business Brokers. If you found value in today's episode, be sure to subscribe, leave a review, and share it with someone ready to take their next step. For more resources and personalized support, visit www.horizonbrokers.com or call 703-910-7384. Thanks for tuning in. See you next time on The Horizon, where buying and selling businesses creates opportunity.